What if I told you that the best leading indicator for the high-tech, trillion-dollar AI revolution wasn't actually a silicon chip, but, well, a massive pile of gray powder?
I mean, it sounds totally counterintuitive, right? But you really can't house thousands of servers in the cloud. You need a physical foundation on the ground.
Right, and a massive amount of it. So today, we are taking a deep dive into the materials you shared with us. Specifically, we're looking at the second quarter 2026 earnings report and presentation for Cemex.
Yeah, and it's a completely fascinating set of sources you brought us.
It really is. Our mission today is to unpack how a very traditional, seemingly slow-moving global building materials company is executing this massive internal transformation.
Right, they're quietly turning themselves into a highly efficient cash generation machine.
Exactly. And in the process, they're setting the physical stage for the infrastructure of the future.
The contrast is really what makes this so compelling to look at. You have this ancient commodity, right? Cement and concrete. But the corporate mechanics driving it are undergoing this really high-speed modernization.
Yeah, and we really need to start with just the sheer scale of the numbers here.
Yeah.
Because when you flick through a financial report for a company that sells, ready-mix concrete and aggregates, you kind of expect modest, steady, maybe single-digit movement.
Sure, you expect a slow and steady chart.
Right. But instead, this second quarter report reads more like a hyper-growth tech stock.
It really does. I mean, the baseline for understanding this transformation is in their consolidated net sales, which reached $4.6 billion for the quarter.
That's huge, and that represents a 7% increase on a like-to-like basis.
Mm-hmm.
And just so we're all on the same page, like-to-like basically means we are comparing apples to apples, right?
Exactly, yeah. It strips out the noise of, currency fluctuation.
Or the impact of selling off a random business unit.
Uh-huh.
It measures the pure organic growth of the business.
Right. And a 7% organic top-line growth is a very solid foundation. But the number that really jumps off the page, I mean, it's the cash flow.
Oh, absolutely. Their free cash flow from operations didn't just grow, it literally tripled.
Tripled, yeah.
It was up 212% compared to the same time last year, hitting a record $637 million.
Yeah.
And their EBITDA hit a record $1.018 billion, which is a 24% year-over-year increase.
And see, that is the metric that matters most to institutional investors. Revenue is vanity, but free cash flow is sanity.
Free cash flow is sanity. I like that.
Yeah, it's the actual money left in the register after you've paid to keep the lights on and the machines running.
Well, and because of that incredibly strong first half, management actually raised their full-year guidance. They had previously told the market to expect, high single-digit growth.
Right.
Now, they're projecting 16 to 17% year-over-year growth. And their EBITDA margin expanded by 2.1 percentage points to 22.2%. So the big question is, how does a mature company with these incredibly heavy, expensive physical assets suddenly triple its free cash flow on a relatively modest 7% bump in sales?
Well, we are looking at a masterclass in what financial analysts call operating leverage.
Okay, let's avoid the Wall Street jargon for just a second. What does operating leverage actually look like, out on the factory floor?
Sure. So think about the underlying costs of running a cement operation. You have these massive industrial kilns that require enormous amounts of energy.
Right.
You have sprawling quarries, and you have huge fleets of heavy trucks. Those are your fixed costs. They exist, and you have to pay for them, whether you sell 100 bags of cement or 100,000 bags.
Got it.
So operating leverage kicks in when you manage to grow your sales revenue while, at the same time, keeping a ruthless, airtight lid on those fixed costs.
Oh, so because you've already paid the rent on the factory, so to speak, every new dollar coming in the door doesn't have to go toward paying that rent again.
Precisely. The cost floor stays completely flat, but the revenue ceiling rises. And when you achieve that dynamic, the extra money doesn't just trickle down. It flows exponentially to the bottom line as pure profit.
Wow, okay.
That is exactly how a 7% increase in sales translates into a tripling of free cash flow. They aren't relying entirely on selling more product, right? They've engineered a system to keep vastly more of the money from the product they do sell.
Which brings up the $475 million question here. Because inflation has been a persistent reality globally over the last few years. Materials cost more, labor costs more. A company doesn't just magically hold the line on costs without some kind of systemic mechanism to fight back.
Oh, they definitely have a mechanism. They have a highly formalized plan for this, which they call Project Cutting Edge.
Right, Project Cutting Edge. According to the presentation you provided, it's moving much faster than even management anticipated. They've already achieved 80% of their initial $400 million savings target.
Yeah, the speed is impressive.
And because they hit that milestone so rapidly, they've actually upped the ante, adding another $75 million to the goal. So they are now targeting $475 million in recurring savings by 2027.
And the core of these new savings is really coming from a fundamental overhaul in their procurement strategy.
Which is just the corporate term for how they buy things from third parties.
Exactly. Everything from raw materials and energy to, spare parts for the trucks and even office supplies.
Wait, can a multi-billion-dollar company actually save $500 million just by centralized buying? I mean, I struggle with this concept a little bit.
How so?
Well, when I look at a household budget, I can cut my streaming services. Sure, I can snake buying premium toffee, but eventually I run out of easy fat to trim.
Right. You hit a wall.
Exactly. If I want to save more, I have to sell my car or move to a smaller house, which fundamentally hurts my quality of life.
Right.
Doesn't a giant company like Cemex eventually hit bone and, cripple their ability to produce?
It's a very fair question, and it's a very common corporate pitfall. A CEO mandates a, say, 15% budget cut across all departments. The departments panic, they delay essential maintenance, they buy inferior parts, and they lay off critical staff.
Yeah, which sounds disastrous.
It is. That is cutting into the muscle, and it almost always damages long-term production. But Project Cutting Edge is taking a structural approach rather than a punitive one.
So what are they actually doing differently in how they buy?
They're completely changing the mechanics of how they negotiate. Historically, a company of this immense size often operates in regional silos.
Okay.
So the office in Mexico might have its own procurement team negotiating contracts for conveyor belts or heavy machinery.
Right.
And the European division has a completely different team negotiating for the exact same items with a different local vendor.
Oh, I see. They're essentially failing to use their massive scale.
That is the crucial shift right there. By centralizing procurement, they take the combined purchasing power of a global behemoth directly to the supplier.
Wow.
They aren't asking a supplier for a modest discount on 50 trucks. They're demanding the absolute floor price on 1,000 trucks globally.
They become the supplier's most important customer overnight.
And they dictate the terms. It's a systemic change to their recipe for doing business. And the presentation heavily stresses that these are recurring savings.
Meaning it's not just a one-time thing.
Right. Once you negotiate that superior global rate, that efficiency repeats every single quarter. It's a permanent structural reduction in the cost floor, not just a temporary belt tightening.
Okay, so centralized cost-cutting is an incredible engine. But they still need fuel, right? Someone has to be buying this stuff out in the real world. So where is the actual demand coming from?
For that, we really need to look at the geographic breakdown because these regional markets are operating under completely different macroeconomic realities right now.
Let's start with their home turf in Mexico, because the numbers here are, frankly, staggering for a heavy industry.
They really are.
Sales hit $1.3 billion. Their EBITDA, which again is a measure of core operating profit, jumped 27% to $491 million.
I mean, a 27% profit increase in a mature single region is a massive outlier.
And it wasn't just driven by price hikes either. Cement volumes actually grew for the second consecutive quarter. And what stands out to me is the specific source of that volume.
Yeah, the mix is interesting.
We tend to associate big cement companies with, shiny downtown skyscrapers or massive suspension bridges. But the drivers listed in this report are incredibly grounded.
The presentation highlights self-construction and residential demand for bulk cement.
Right, which is literally just a family deciding to add a concrete block room to their existing house. Or the government paving a rural dirt road to connect a remote village. They specifically call out government-backed social housing programs.
Yeah, these localized grassroots efforts are moving the needle to the tune of hundreds of millions of dollars for a multinational corporation.
But volume is only a crucial part of that 27% profit jump, right? We also have to look at the other side of the ledger, which is their pricing power.
Exactly, because even with Project Cutting Edge, the raw inputs to make cement in Mexico are still subject to inflation.
Right, the stuff they buy to make the cement still costs more.
Yeah, if your input costs go up 5% and you can't raise your prices, your margin shrinks. But Cemex managed to implement sequential price increases across their 3 core product lines in Mexico: domestic gray cement, ready-mix concrete, and aggregates.
Sequential meaning they steadily bump the price up quarter after quarter.
And they did it surgically enough that it perfectly offset the global input cost inflation without killing the demand.
It's hard to do.
Very hard. Passing costs down to the consumer is a dangerous tightrope. Push too hard, and that family decides not to build the extra room. The volume growth proves they found the exact right balance in the Mexican market this quarter.
Okay, so Mexico is clearly firing on all cylinders. But geographic diversification means taking the bad with the good. When we look at the U.S. market, the narrative shifts dramatically.
The U.S. numbers are definitely the pressure point in this earnings report.
Yeah, U.S. EBITDA actually dropped 11%, down to $248 million. And the primary headwind cited by management for this drop is unusually high precipitation. Basically, bad weather impacting key markets.
Rain.
Yeah, rain. I always roll my eyes a little bit when I read this in an earnings report. I mean, do corporations just use the weather as this undeniable scapegoat when they miss their quarterly targets? Sorry, investors, it rained too much.
Look, analysts are naturally skeptical when weather is the headline excuse for an earnings miss. It can definitely be a crutch, but we really have to look at the physical reality of what they are selling.
Fair enough.
You cannot pour a massive concrete foundation for a commercial building in a torrential downpour.
Because it dilutes the mix.
Exactly. It completely compromises the structural integrity of the concrete. The water-to-cement ratio is a very precise chemical formula. If the sky opens up and dumps an inch of rain into your forms, that foundation is ruined. So weather does cause absolute, non-negotiable work stoppages in this industry.
Okay, I will concede that you can't pour concrete in a flood. But that brings up the real concern for an investor or anyone watching this space. Is that money gone forever, or is it just delayed? Like, did the client cancel the project, or are they just waiting for the mud to dry?
The data in the presentation leans heavily toward delayed gratification. The underlying infrastructure demand in the United States remains incredibly robust.
Well, they explicitly cite the IIJA, the Infrastructure Investment and Jobs Act. The federal money for bridges, highways, and public works is still flowing into state budgets.
Federal spending is the baseline, absolutely. But the private sector pipeline is where the long-term story gets really interesting. Cemex notes that their geographical footprint in the U.S. encompasses roughly 35% of planned mega projects.
Okay, and the report defines a mega project as anything over $500 million. So what are these massive developments?
We're talking about gargantuan data centers to power the artificial intelligence boom and semiconductor chip fabrication plants being built onshore to secure domestic supply chains.
Oh, wow. And these aren't just generic warehouses, right? A semiconductor plant requires highly specialized, abrasion-resistant concrete foundations to protect the microscopic manufacturing processes.
Absolutely.
And data centers require massive structural supports and heavy-duty cooling infrastructure.
These facilities require millions of cubic yards of specialized concrete. Having your operations physically located near 35% of these planned mega projects is a massive competitive moat.
Because cement is heavy.
Very heavy and expensive to transport. You can't ship it across the country profitably. You have to be local. So the demand from these tech giants hasn't evaporated at all. It's simply backed up behind a rain cloud.
So the U.S. pipeline is fully loaded, just waiting for clear skies. But managing a global portfolio isn't just about selling cement, is it? It's about strategic positioning. It's knowing when to cash out of a market entirely and how to account for the unpredictable.
Yes, and the adjustments in their global portfolio offer some real masterclasses in capital allocation.
Let's look at the EMEA region. Europe, the Middle East, and Africa. Their EBITDA there jumped 24%. However, the sources provide an important caveat here. That headline number includes a $42 million favorable one-off claim settlement in Europe.
Right, and it is crucial to separate a one-time cash injection from organic business operations. A legal settlement is great for the balance sheet, but it's not a repeatable business model.
To be fair to Cemex, though, the report shows that even if you strip out that $42 million, the underlying EMEA profits still expanded. Then you have the SCAF region, South, Central America, and the Caribbean, where EBITDA grew a massive 34%. And the drivers there are a fascinating study in contrasts. You have resilient, informal construction, much like we saw in Mexico, but also massive reconstruction efforts following Hurricane Melissa in Jamaica.
It really highlights how extreme weather events are a double-edged sword for building materials. In the U.S., heavy rain stalls new construction and hurts the quarter. But in the Caribbean, a destructive hurricane creates an immediate, urgent surge in demand for reconstruction materials.
The physical realities of the industry are stark, that's for sure. But the part of their global strategy that I really want to unpack is their decision to intentionally shrink.
Yeah, divestments are often misunderstood as a sign of weakness.
Right, because they sold their Panama operations for $200 million, and the financial tables show this resulted in a $63 million accounting loss on disposal. Furthermore, they are in the process of divesting their Colombia assets for another $485 million. Why would a company generating record profits deliberately shrink its geographic footprint and take a $63 million loss to do it?
This is the essence of capital allocation. You don't need to plant your flag in every country on Earth. You just need to be in the markets where you have a clear path to market dominance and high margins.
So even if Panama was making some money, it wasn't making enough money to justify the headache.
Exactly. Maybe it requires too much executive bandwidth, or the long-term growth prospects are stagnant compared to other regions. By selling the Panama operation, even if you have to swallow an accounting loss on the books, you free up $200 million in actual liquid cash.
Oh, I see. And you combine that with the $485 million from Colombia,
Yeah.
and you suddenly have nearly $700 million in dry powder.
You pull that capital out of slower growth regions, and you can deploy it where it generates the highest return. You can pay down debt to lower your interest expense, or you can reinvest it into expanding your footprint around those U.S. megaprojects or the booming Mexican market.
It's like pruning a tree. You cut off the lower branches so the main trunk can grow stronger and taller.
That's a perfect way to look at it.
Well, that transition from shedding old assets to investing in new growth brings us to the final piece of the puzzle. We spent a lot of time on where Cemex is operating.
Yeah.
We need to look closely at what exactly they are selling in the modern era, because it is evolving rapidly.
The stereotypical image of a cement truck churning away is really only one part of the modern business.
Right. They highlight a newer segment called Urbanization Solutions. The growth trajectory here is intense. Sales jumped 14% to $442 million, and the EBITDA was up 27%, carrying a massive 22.8% profit margin.
Urbanization Solutions includes things like performance-enhancing admixtures, special mortars, and precast concrete products. These are higher-value, specialized materials.
And deeply intertwined with that higher margin segment is their sustainability initiative, known as the Future in Action Program. The sources state they reduced gross CO2 emissions by another 1% year to date.
Which is huge for this industry.
Yeah. And they achieved this primarily through two distinct levers. Lowering their clinker factor to 70.5%. and utilizing 27.6% alternative fuels.
The science of decarbonizing building materials is one of the most critical engineering challenges of our time.
Okay, I need a plain English translation here, specifically for the clinker factor.
Sure.
Let me try an analogy to see if I'm grasping the chemistry. If I'm baking a loaf of bread, clinker is essentially the flour, right?
Okay, I follow.
It's the core essential ingredient that makes the cement bind together and harden. So what Cemex is trying to do is figure out how to bake a structurally sound loaf of bread while using less and less flour, substituting it with other less carbon-heavy ingredients.
That is a brilliant way to conceptualize it. Clinker is the crucial binding agent. To make it, you have to superheat limestone in massive industrial kilns to temperatures exceeding 1400 degrees Celsius.
Wow.
And that chemical reaction calcination releases enormous amounts of carbon dioxide straight from the stone itself. It is the primary reason the cement industry is responsible for roughly 8% of global carbon emissions.
Okay, so by lowering the clinker factor, using less of that carbon-intensive flour, so to speak, and replacing it with specialized supplementary materials like fly ash or slag, they directly reduce the emissions of the final product.
Without compromising the strength of the concrete. And the second lever, alternative fuels, addresses the intense heat required for those kilns.
Because getting a kiln hot enough to melt rock requires a lot of fire.
Traditionally, that meant burning mountains of coal or petcoke. But instead, they are substituting over 27% of that energy with alternative fuels. This can include biomass, agricultural waste, or even a municipal solid waste.
Wait, really?
Yeah, they're essentially burning processed trash instead of fossil fuels to power the kilns.
I have to admit, I'm always slightly cynical when I read ESG initiatives and corporate reports. Is this just greenwashing? Are they doing this just to secure a better rating on a sustainability index and generate some good PR?
And that is the most profound takeaway from the segment of the report. It is fundamentally not just PR. Go back to those 22.8% profit margins in the Urbanization Solutions segment. Utilizing alternative fuels like municipal waste is often significantly cheaper than purchasing coal on the volatile global commodities market.
Oh, wow. In some cases, municipalities might even pay them to take the waste off their hands.
Exactly. And lowering the clinker factor means producing less of the most expensive, energy-intensive component of the cement. Lower carbon emissions literally equal lower production costs.
That's incredible.
It widens their profit margins while simultaneously shielding them from the financial impact of increasingly strict carbon taxes in places like Europe. They are demonstrating that in modern heavy industry, sustainability and profitability are no longer competing interests. They are becoming the exact same mechanism.
Let's bring all of these threads together for you, the listener. The overarching narrative we've pulled from this stack of financial tables is clear. Cemex is proving that even the most ancient, physically heavy, deeply traditional industries are capable of profound agility.
Absolutely.
They're aggressively centralizing their costs, pruning their global portfolio, and innovating the actual chemistry of their product at scale.
It really forces you to reevaluate what a dynamic company looks like today.
Yeah. And why should you care about the earnings report of a concrete company? Because these organizations are the ultimate macroeconomic bellwethers. If you want to know if the artificial intelligence boom is rooted in reality or just speculative hype, look at who is actually pouring the millions of tons of foundation for the data centers. The digital world still fundamentally relies on a physical footprint.
The flow of building materials is the most reliable leading indicator for where institutional capital is actually being deployed.
And that leaves us with a final provocative thought for you to explore on your own. As these giant corporations pour hundreds of millions into research, developing proprietary chemical binders and ultra-low carbon concrete recipes. Wait, actually, will building materials eventually be valued less, like physical commodities pulled out of the earth, and more like patented high-tech intellectual property?
If the recipe itself becomes a protected technological asset, it completely upends how we value the physical world.
It changes the entire paradigm. The next time you walk past a loud, dusty construction site, you might actually be looking at the next major breakthrough in climate technology. Thank you for bringing such a rich and surprising set of sources to the table today. We love taking these deep dives with you and uncovering the dynamic stories hidden inside the static numbers.